Hello, everyone. Welcome to TC Group's webinar on business property relief. Today, we'll be sharing the latest on business property relief following the changes that were announced in last year's autumn budget. So before we begin, I just have a couple of housekeeping points to go through. So the webinar is being recorded and will be available to watch back on demand. For all of those who are joining us live, you'll receive a link to watch the recording via email afterwards. We also have a Q&A at the end of the webinar, so feel free to submit questions at any point using the Q&A button, and we'll come to those towards the end of the webinar. And then lastly, just a reminder that this webinar will provide you with general information. However, for professional advice tailored to your own situation, we do recommend speaking to your local TC Group team or getting in touch with us after the webinar. I'll now hand over to Graham Boar, who is one of our tax partners here at TC Group, and he'll be leading us through the changes to business property relief. Over to you, Graham.
Yeah, lovely. Thank you, Megan. Good morning, everybody. So we're going to look at some BPR changes today. We're going to have a little look at the history of BPR. We're going to have a little look at what's not changing, what's staying the same. We're going to have a little look at what is changing, and then we'll finish off by looking at the sorts of things taxpayers maybe ought to be thinking about in light of those changes. So if we could go forward to the history of BPR, please, Megan. So business property relief. It's worth mentioning there were changes to agricultural property relief as well. We're not really focusing on those today. There are quite a lot of similarities. They've had a lot of attention in the press, and I think BPR maybe a bit less so. So main focus on BPR. This is a relief that was introduced in 1974-75 when estate duty was being replaced with capital transfer tax. And it was initially at a rate below 100%. I think the lowest rates were down at about 30% when it was first introduced. For about the last 35 years or so, the top rate of relief has been 100%. So we've got very used to enjoying this relief as a 100% relief. Very long-standing relief, a little bit of attention from time to time, but it's been there an awful long time. Next slide, please. So in terms of prior to last year's budget, with this fairly well-established position, so unquoted trading businesses, whether that was shares in company, partnership interest, self-employed types of business, and potentially eligible for this 100% relief. We had a couple of categories where you would only ever get 50% relief. Most commonly, that was you had a business owner with a 100% relief business, and they maybe owned land and buildings or plant machinery personally that was used in that business. So that was the starting point before last year's budget. We can go on to what's not changing. So this relief is still targeted at what we call trading businesses. You can see the little description on the screen. That's the wording from the legislation. Doesn't actually use the word trading anyway, but it's a bit of a mouthful, and we talk about trading businesses. So if it's a passive investment type of business, so rentals or stocks and shares or things like that, those are not BPR businesses. If it's an active doing things, selling things, making things type of a business, they're the types of businesses we're talking about. And that's not changed by these budget announcements. We're also not changing or not seeing a change to the ownership requirements. So there is a lead-in period. You can't just get a qualifying asset and immediately have relief. There's a 2-year lead-in period, and you can't have relief on an asset that you're in the process of selling or that you have established a binding contract for a sale in respect of. This 2-year period was actually, it's one of the reasons things like AIM shares were so popular, was it compared very well with the 7 years that you had to give an asset away. You had to survive by 7 years. Clawback is also not changing. So the way that clawback operates can be very complicated, but in a nutshell, the idea is if you make a lifetime gift of a BPR asset, you might not survive that gift by 7 years. And in that instance, there's a kind of double test. We look at what was going on when you made the gift. Does that sort of open the door to eligibility? And then we look at what was the situation when you died within 7 years of making that gift, and has anything changed which would lead to the eligibility being withdrawn. So those rules are still going to be with us under this new regime. Also, the changes we've got are inheritance tax changes. So almost impossible to think properly about inheritance tax without thinking about capital gains tax and what those consequences are. There's kind of long been a conundrum for business owners in terms of, do I give it away during my lifetime? Do I keep it until I die? What does the inheritance tax look like in either of those options? But also the capital gains tax difference is quite stark between those options. So anytime we're thinking about these BPR changes, what do they mean for me? It really is going to be necessary to think about, well, what about the capital gains tax aspect of this, and whether that makes a difference to our thinking. So that's kind of the end of everything that's staying the same. We can move on to look at what's going to be changing. Awful lot was made of AIM shares. They were sort of announced during the Chancellor's speech. They were in all the media follow-ups for the following week, and it's where a lot of the heat and noise in the debate that followed was around what's changing on AIM shares. So previously it was possible to get 100% relief on AIM shares. Subsequently, they will never qualify for more than 50% relief. I think what's a little peculiar about this, it seems strangely targeted at AIM shares rather than at some of the other investment type products that have been designed to get BPR. So I think there are still other products on the market that maybe are eligible for 100% BPR. It's hard to imagine that was a deliberate choice, and I wonder whether that will be addressed in a subsequent budget once someone works out that they've sort of left a loophole behind. It seems fairly likely that that will happen. Then the headline of what's changing on, if we go on the next slide, please. £1 million cap on 100% relief. This is the big news story, the newspaper headline. This is the thing people have heard about. So taxpayer dies, they have assets which are eligible for BPR at 100%. From April 2026, that relief at 100% will be no higher than £1 million for that taxpayer. And that £1 million will take into account things that have happened during lifetime, as well as what is owned at the date of death. The really important point on that slide, the £1 million allowance is non-transferable, whether that's between spouses or otherwise. We've all got very used to the transferability of inheritance tax-free allowances between married couples, civil partnership couples. That's been around since about 2008, so really well established that most of those allowances do transfer, and we can be quite relaxed about them. We'll be a lot more disciplined with these BPR changes, because if one spouse doesn't use that allowance, it's just gone. They can't transfer it, and then the surviving spouse can't have double allowances. It's just been wasted. There's a little footnote on there as well that there will be some index linking to this £1 million, but not until 2030. So we've got about 5 years of it at a fixed £1 million monetary limit. Like to think the index linking then does take effect, but it's worth remembering all those inheritance tax allowances are meant to be index linked, but since 2010, they've been cut off every year so that they don't go up. On the next slide, so chargeable lifetime transfers. We have broadly two types of transfer that are made during lifetime. We have pets, potentially exempt transfers, and those are gifts to individuals on the whole. We have CLTs, which are chargeable lifetime transfers, and those are gifts to a trust is the overwhelmingly most common one. Gifts to a limited company as well, you don't see that very often. So at the time it's made, these changes don't impact pets. So if we're giving things away to individuals, the gift can be of any value, any monetary amount. And if you survive that gift by the 7 years, it becomes exempt and the cap doesn't come into play. So it's only failed pets, gifts which you don't survive by the necessary 7 years, where you then have to come back and apply this cap. But it continues to be the case that you can make unlimited value pets as long as you survive them by 7 years. For chargeable lifetime transfers, as the name suggests, those are chargeable when made. And so they are actually going to be subjected to this cap in real time. And I think I won't go into the detail on that because I think it's on the next slide, but really CLTs or pets made more than 7 years before death, they won't use up your tax-free allowance that's available on death. So although they're taxed slightly differently in their own right, as long as you survive those lifetime gifts by 7 years, you can expect to have a personal £1 million allowance on death. So if we go on to the next slide, we're going to look at what this looks like for trusts, and it's a bit messy, a bit full on. It's kind of necessarily complicated. It's 3 distinct time periods. So we've got pre-existing trusts. So these are trusts that were in existence before budget date, had business property in them before budget date. And they're sort of grandfathered into a favourable regime. They have their own £1 million cap on BPR. It doesn't make any reference to other trusts created by the settler. It doesn't matter what else the settler has done since. That trust is kind of grandfathered into the old regime and enjoys its own £1 million cap. Those existing trusts, they're gradually dragged into the new regime as they go through their 10-year cycles. So when they hit their first 10-year date after the rule change, they're gradually dragged into the new regime, but still, as I say, still always with that cap available to them, which is a bit of a benefit. But everything since budget date, they're going to be much more closely affected by the new rules. But we are in a transitional period. So if we look forward to April 2026, from that point, the new rules are fully in effect. The amount that you can put into a trust with the benefit of 100% BPR is capped at £1 million. So the ability to load up a trust with value in the form of shares in a company, a family company, a trading company, that's going to be curtailed quite dramatically from April. Between budget day and next April, so the period we're in currently, we're in this transitional zone where there is still an unlimited availability of BPR on the creation of the trust. So we still have a while stock's last opportunity to get quite high values of business property into trusts. If it's done before next April, you'll have locked in that 100% relief for the creation of the trust. They obviously go into the new regime moving forward. So the 10-year charges and things, they're subject to the cap. but beating that entry charge, being able to put a high value of business property into a trust, that's a real opportunity. And we've got maybe, what, 6-7 months left to take advantage of that opportunity where it's appropriate. And that kind of takes us on to our fourth section. What can you as taxpayers do in relation to these new rules? So it's some really easy kills, which correspondingly can be really easy misses. So the spouse and civil partner allowance, as we said earlier, not transferable, so really important to use that. So have we got a family business where not both of the parties to a marriage or a civil partnership own shares, or own shares which are going to take them up to that £1 million threshold? Have we got arrangements in place, whether that's wills or something else, where one spouse might die and leave assets back to the other spouse, wasting the allowances by, transferring it back to where it started? And the benefit of looking at this between spouses and civil partners, firstly, from a tax perspective, got a very broad-ranging capital gains and inheritance tax exemption for spouses and civil partners in most instances. So it's quite easy to make those transfers normally. Also, spouses and civil partners, you're moving assets around, but the money is staying in the same household. So in terms of things like affordability or financial position, the money is still in the household. So that's an area to look at, and possibly an area where we find some really, some quite easy kills that we might put in place. If we're looking at the wider family, really worth looking at. This is definitely worth looking at. It's not as easy as spouses, civil partners. So no inheritance tax exemption, no spouse exemption for capital gains tax when we're transferring to maybe children, grandchildren, or other people within the family. So we need to think about capital gains tax. What does that look like? Inheritance tax, what does that look like? Do we need to survive these things? Do we need to think about the clawback? Also, the money is obviously going out of the household in this example, assuming the children are adults, they don't live with you. So financially, if we're giving some stuff away to family members, we're likely to lose the capital value, we're likely to lose the dividend stream, etc. So what does that look like? We get things like concerns about maybe the spouses, partners, civil partners, whatever, of the children. So if we give them shares, but we don't like the son-in-law, the daughter-in-law, whatever it might be, what does that look like? Can we protect it? Is that a factor? We also get the situation quite commonly. There might be more than one child. Maybe one of them is involved in the business. Maybe one of them isn't. So, okay, we could start sharing ownership of the business around the family. How does fairness come into it? How does the perception of the one who works in the business compared to the one who doesn't work into the business come into it? So lots more to think about with these family ones, but some real upsides, headlines of getting some gifts in the bank now, and that can have some advantages. Maybe increasing the number of these £1 million allowances we've got, because maybe we've got the sort of couple at the founder generation with their own allowances. Maybe we've got more than one at the next generation with their allowances. Maybe we've even got a trust in there with its own allowance. So we start building up these allowances. We also might get some fragmentation, valuation discounts. So if we start breaking down how those shares are owned, there are some anti-fragmentation rules for the trusts and so on, but if it's broken up around different family members and so on, you might find that you start getting minority discounts, things like this, so that actually just the value that is exposed to tax is brought down a little bit by virtue of those discounts. So some real potentially valuable things, some valuable rewards for doing this, but it's not going to be just as simple as, oh, we'll give some shares to the children and move on. It's going to need much more thought than that. Trust shareholders. If you've got pre-existing trusts, I mentioned those are sort of grandfathered into a slightly better position. So anyone who's got a trust which owns an interest in a family trading company, definitely be taking advice before you disturb that trust, because it might be sitting in an advantageous position, and once you get rid of it, you probably can't get that advantageous position back. We might be looking at introducing trust shareholders now, especially if you're thinking about moving significant value business property down through the generations, maybe through a trust. That opportunity currently exists from April 2026. That value cap is going to really curtail how much you can put into a new trust. So I mentioned that kind of time limited opportunity. If we want to create a high value business property trust, we want to be thinking about that sooner rather than later. And there's going to be a lot of nuance around this, the interplay with capital gains tax in particular. So in some circumstances, some families, it's going to be really attractive to start moving value through a trust, perhaps maybe down to family members in due course, and starting that process now. Other circumstances, it might be that the intentions for the business mean actually the capital gains consequences of doing this make it less attractive, and maybe would make you think twice about doing it. But quite a bit to think about with trusts and creating new trusts. On the next slide, it's worth thinking about some of the simple stuff too. So we touched on eligibility earlier. Are you eligible? Let's make sure we stay eligible, because £1 million at 100% relief, 50% relief over that £1 million, this is really generous. So this is relief we really want to make sure we take advantage of. Do we need to take a review of what that business or that group looks like? Have we got problem assets in there that need thinking about? If we can't avoid a tax charge, or if we think there's going to be a tax charge, how's it going to be paid? Thinking about liquidity, where's that money going to come from, and actually just having a plan to manage the tax, that can be part of the equation as well. So ideally, we'd like to improve the tax position, and we'll do that as far as possible. If we're left with a tax bill, how are we going to actually deal with that tax bill? I think that's really important. And lastly, you might have a business owner who has died before these changes come in. So in those scenarios, if someone's died fairly recently ahead of the changes, what does their will say? Is it making good use of the reliefs? Is it, for example, pooling a load of that value with a spouse? And might the executors be able to do something about that? You might be thinking about a deed of variation. You might be looking at whether the will already creates a trust and how we approach that trust. But if you do find yourself in that unfortunate position of being responsible for the estate of someone who has died, I think it will really pay to just set some time aside, have a look at this. You're generally going to have up to 2 years beyond the death to do something about it. So quite a tight window, but also plenty big enough as long as you, as long as you take some advice and grasp the nettle and look at it. So some opportunities for those situations as well. I think that takes us to about 5 minutes left, Megan. That's covered everything. So
yeah, that was brilliant.
Questions.
That was great. Thank you for that. It's good to sort of hear what's changing, what's not changing, and those potential quick wins. If anyone has got any questions, feel free to drop them in the Q&A box now. We had a couple that came through ahead of the webinar on email, so I'll start with those ones. So the question was, as pensions are being subjected to inheritance tax, will this relief also apply to pension funds?
Okay, so pensions have been outside the scope of inheritance tax historically. They're going to be brought within inheritance tax from April 2027. We got some draft legislation over the summer, and it was explicit that BPR and APR will not be extended to pension funds. So there was a bit of hope that it might be, and that might help some of these pension arrangements out. It's not going to be, and those people are going to have to look at alternative ways of managing the exposure on those pension funds. Got a little more time for those because that's April 27.
Right. And that does kind of link on to another question we had, which is there any likelihood that the rules won't be introduced, seeing that we are quite a few months out still?
Yeah, almost the same answer. So they published draft finance bill clauses on the 21st of July. So no prospect of it being put in the bin. It might get tinkered with on the way through. You know, it's got to go through House of Commons readings and House of Lords readings, and there'll be a committee on it and so on. So it might get tinkered with, but it's not going to materially change, and it's certainly not going to change for the better. It is happening.
So one of the questions that we've had through, so from Jonathan, he's asked, how will the company be valued on death? If the person has died that is integral to the business, will there be any significant discounts on the valuation?
But these are kind of one-man band type of companies. Sadly not, because the way the inheritance tax rules apply a charge, they create a notional transfer of value immediately before death. So you're actually valuing that company just before that integral person dies. So at the point you're valuing it, they're still alive, and everything is as it was when they were still alive. In terms of the valuation more broadly, you're going to be valuing the whole of the company and then using that whole of company valuation to work out, all if I've got less than 100% of the shares, what's my shareholding worth? That's where these fragmentation rules might help out. So certain trusts, we've got the anti-fragmentation, we're going to have to value clumps of shareholdings, maybe across several trusts or several individuals. But if we've got lots of different family members, we might start getting into actually a 20% holding commands quite a high minority discount.
We've also had a question from Darren, who has asked, for transfers to family members, can you explain when the holdover claims are available to avoid the capital gains tax hit?
Yes. So if you're transferring into a trust, then holdover is available, full stop, doesn't matter. That's section 260 holdover. If you're transferring to individual family members, you need to rely on section 165, which is a lot less generous. So you need, firstly, you need a trading business. I'm assuming a company here for the time being, so shares in a trading company. And for capital gains tax purpose, that's at least an 80% test compared to the sort of 50% inheritance tax one. So a much higher starting bar. You actually also then have to look at whether that company has got any problem assets on the balance sheet. So it might be a trading company, but it might have, for example, an investment property on the balance sheet. And if it does, that's going to restrict the amount of holdover that you can claim. There's also if you're ever thinking about holdover, you need to be thinking about tax residents. It needs to be people who are in the UK. You can't hold over again to someone overseas.
Oh, that's good to know. And a question from Jenny. So we've mentioned about that those with significant property value need to act, but she's asked if the business property is not of high value, so it's below 200,000, is it worthwhile acting before April 2026 still?
So if you're confident your valuation's going to be lower than your available £1 million cap, still some housekeeping, that stuff about check that you are eligible, make sure your will says what it wants to say, those sorts of things. But if you're eligible for relief and you're happy that you're going to be within that £1 million cap, great, you carry on. It's people who've got assets at a value where that £1 million cap could come into play. They're the people who are going to be impacted by this. I think that's part of the government's logic. Just as an aside, that the majority of BPR claims are relatively low value, but the minority of claims that are higher value tend to be much higher value and are going to be really dramatically impacted.
That's brilliant. Thank you. Thank you everyone for your questions. Just with timings, we'll move on. However, we'll come back to anyone who has submitted a question and we'll come back to you on email. So just before you go, I've got a very quick poll, just asking if you would like any further personalised support. If you could please answer in the poll and we'll be sure to get in touch with a free consultation. So we'll just give everyone a few seconds just so they can answer in that poll. So that will be covering the topics that we've discussed today around the sort of the spouse and civil partnership allowance, AIM shares, trusts, and obviously, of course, just general business property relief with your own circumstances. I'll just give that a few more seconds. And as I mentioned, the recording will be shared afterwards with you as well. So this will be sent to you via email tomorrow, so you can watch back on demand at any time or date that's convenient for you as well. Lovely. Thank you for answering that poll. And brilliant. Thank you everyone for watching.
Thanks, everyone.